Good afternoon and welcome to our virtual class in your subject, Fundamentals of Accounting Theory and Practice, and that is ACTG 6153. Our discussion this afternoon is already on the week 13 module, and this is entitled Accounting for Merchandising Operations. And I'm your professor, Susan Maminta from Ama Ilis Rizal branch. In our discussion today, our learning outcomes are: one is for you to learn to define merchandising, also understand the additional account titles and terminologies for merchandising, understand the operating cycle of a merchandising business, and to understand the two inventory systems and how to record transactions under each system. So what is merchandising? Merchandising is also called trading. It is a form of business operations involving the purchase and buying of goods or merchandise and selling the same in its original form. Others call this as buy and sell business. Now let's compare merchandising to a service type business and a manufacturing type of business. For a service business rendered services to others and that they earn revenue on that services. While a merchandising, the business buys merchandise and sells the same, changing nothing but the price. A merchandising firm purchases their products or merchandise to be sold as is, while manufacturing company purchases raw materials, convert them to finished products or goods which they will sell. The output of a manufacturing firm is the merchandise that a trader or merchandiser will buy and sell. In our discussion about merchandising, there are additional terminologies and account titles on this type of business. So we have this sales. This sales is an account referred to the revenue of a merchandiser earned by selling goods or merchandise inventory. Another terminology is this net sales. This pertains to the excess of sales over the sales discounts and sales returns and allowances granted by the seller to its customers. Another account is the sales discount. This is the amount deducted from accounts receivable from customers for paying promptly on their accounts. This is a contra account of sales. The sales return and allowances, also known as a contra account of sales, pertains to the decrease in receivables from a customer for returning the merchandise. And a trade discount refers to direct reduction in selling price of good or merchandise to encourage customers to buy. This is not recorded in the books. Cost of goods sold is the cost of the merchandise inventory that the merchandiser has sold. This is also termed as cost of sales. A freight out or a delivery expense is the account used to record the cost of transporting the merchandise from the seller to the buyer or to the customers. Gross profit, this is the excess of net sales over the cost of goods sold. Purchases is the account. It is debited for the amount of goods purchased or bought by the merchandiser from his suppliers for resale to the customers. And a purchase returns and allowances refers to the merchandise bought and returned by the merchandiser to the supplier. Maybe it's because of some defects, or an amount given by the supplier as a deduction from the total purchases of the buyer. And this is a contra account of purchases. A purchase discount is the amount deducted from the trade payable of a buyer to his supplier of goods because of paying on their agreed time. This is also known as contra account of purchases. A freight in or transportation in is the cost of transporting the merchandise from the supplier to the buyer or merchandiser. I have here an example of the operating cycle of a merchandising firm. Here we have the two kinds of sales, the cash sales and the sales on account. Okay, when it is a cash sales, okay, we have this flow that the cashier that is being used for the purchases of the merchandise, and that merchandise is the inventory of the company, and this is the one used in the selling or the items for selling, and with that, with the sales of this merchandise or inventory, the company receives cash, and this cash, of course, go back to this cash, the original cash. No? Well, the sales on credit, you use your cash again in the purchases of your merchandise, and then the merchandise will be the inventory or item for selling, and this is the sales on account, so therefore there will be an accounts receivable. So upon collection of the accounts receivable, that's the time that the company receive cash again. We have two inventory system under this merchandising business. And the purpose of inventory is to trace or determine the quantity of goods that are still available for sale. So we have the periodic inventory system and the perpetual inventory system. Okay. For periodic inventory system, it is a process of determining the merchandise inventory level and measuring also the cost of goods sold with the physical count of the merchandise done occasionally. This can be monthly, quarterly, semi-annually, or annually, or at the end of the accounting period. So under periodic inventory system, with the following transaction like purchases of merchandise, we debit the purchase account. And for the discounts given by the supplier, you credited the purchases discount. And for the return of merchandise, you credit the purchase returns and allowances. And for the payment of costs of transporting goods from supplier, it is a debit to freight in or transportation in. The inventory account and the cost of goods sold under this periodic inventory system are updated or adjusted at the end of the accounting period. So the cost of goods sold is calculated in this manner. You add the inventory beginning plus the net purchases plus the freight in less inventory end. The net purchases means the purchases less purchase discount less purchase returns. And the merchandise inventory N is the result of the physical count. Now, in recording sales is very simple under periodic inventory system. If it is a sales in cash, you debit cash and you credit sales. And if it is a sales on account or credit, you debit accounts receivable and just simply credit sales. For the discount given to customers, you debit sales discount and you credit accounts receivable. And for the merchandise returned by customers, you debit sales returns and allowances and you credit accounts receivable. Now, let's see this perpetual inventory system. Now, this perpetual inventory system provides continuous transaction to records the quantity, amount, and kind of inventories that a business has. The company employs a computerized accounting system where every barcoded item in the inventory of a business is linked to electronic records that produce a record of sold items and automatically decreases the inventory after the invoice was entered and completed. In perpetual inventory system, the purchases of inventory is a debit to a merchandise inventory account and a credit to cash or accounts payable. And for a return of merchandise, you debit the accounts payable and you credit the merchandise inventory. And for the purchase discount, you debit the accounts payable and you credit the merchandise inventory. And for the transportation cost, you debit the merchandise inventory and you credit cash. Transportation cost is considered as part of the cost of the merchandise. So as you can see here, the entries or every transactions that has relations to the every transaction that has relations to the merchandise or the items for sale, then you directly use the merchandise inventory account. Now let's look at the recording of sales. Okay. In the recording of sales under perpetual inventory system, if it is cash or accounts receivable, of course you have to debit cash or accounts receivable if it is on account, and you credit sales. But this must be followed by an entry to a cost of goods sold that should be debited and credit the merchandise inventory. For a recording of sales return, you debit the sales return and you credit the accounts receivable, but this must also be followed again with the entry on the merchandise inventory debit and you credit the cost of goods sold. So we have different kinds of discount under this merchandising. One is the trade discount. Trade discount is the amount that a manufacturer or a merchandiser deducted from the listed selling price, or what we call the catalog price of a product when it is sold to reseller and not to the end consumer. So this is not recorded in the accounting books. The amount to be recorded by the seller is the invoice price. That means less the trade discount. Okay. Another kind of discount is the cash discount. This cash discount is the amount from the invoice amount of the seller. This discount is given by the seller when the buyer pays the invoice amount earlier or on the stipulated terms or date. It is sometimes stated as percentage of the total amount of the invoice. So when the merchandise is purchased by a merchandiser, the cost discount is called purchase discount, while when the seller is giving discount, it is termed as sales discount. So that ends my discussion this afternoon, and I'm now giving you my last slide. Class, again, thank you for listening.